Did you know that an investing expert warns against buying Tesla stock now? Even experienced investors heed experts' words, and so should you. Stay tuned and keep watching. With the threat of inflation and recession looming around, investors are scrambling to manage their investments so they would not be affected as much. A lot of companies' stocks have been experiencing extreme fluctuations, including large corporations like Apple, Google, and Tesla. In today's video, you will find out why experts warn not to buy Tesla stock now. Tesla, a clean energy company, is leading the manufacturing of electric vehicles or EVs. Tesla is accelerating the world's transition to sustainable energy with electric cars, solar, and integrated renewable energy solutions. Tesla is famous for several reasons, including new regulations on safety and vehicle emissions, technological advances, and shifting customer expectations. Tesla sales will comfortably grow above 50% in 2022 compared with last year, despite supply chain problems. CEO Elon Musk said earlier this year, thanks to their new factories starting up and current plants boosting output. However, Morgan Stanley pointed to the Berlin factory as a source of concern. Morgan Stanley is an American multinational investment banking and financial services company that helps people, institutions, and governments raise, manage, and distribute the capital they need to achieve their goals. They warned that Tesla factories have been running below capacity for several quarters because of supply chain issues. Dan Nathan, principal of Risk Reversal Advisors, which offers consulting services to investment banks, investment advisors, and private companies, recently shared his stance on buying Tesla stock. When asked if he would be buying Tesla since he mentioned that he is nibbling on the triple Qs, he answered, "Nope, nope, nope." He explained that he, like others, do not know what is going on with the deal. He added to say that he actually hates the fact that it is a top 6 name in the QQQ. Nathan believes that it is going to eventually drop out of that rank in the future. He added that he thinks that Tesla stock has a lot of room to run and that a large part of the premium in the stock is because of Musk's present aura, especially given his controversial stake on Twitter. Nathan personally believes that it is a huge mess since Musk wants to buy Twitter but can't afford to buy it since Tesla's stock price keeps going lower. In fact, experts warned that although Tesla stock's valuation is getting closer to reasonable levels, it may not stay there for long. Dan Nathan told New Abnormal co-host Molly Jong-Fast that Elon Musk doesn't have enough cash to buy Twitter for $44 billion, despite being the richest man in the world, which is why he's selling Tesla stock to get some of that cash in hand and then bringing in private equity and venture capital to cover the difference. According to Nathan, the problem is simply the stock is not worth $43 billion, when all of its public comps are going much lower every day on a NASDAQ that's careening lower, which is down about 27% on the year. He added that it makes absolutely no sense to pay that unless Musk thinks he can take it private and have some really smart co-investors with him and retool this thing, and it comes out as a $100 billion business. However, he continued to say that without Elon, if he is in fact no longer interested, and if Tesla goes too much lower, and Twitter's value sticks out like a sore thumb, being way overexposed, all of those private equities and VC people who've lined up to co-invest with him will be gone if he's not there, since part of the allure is riding his coattails. Nathan said, "People think he's a genius and he'll be able to fix all the big problems." It can be remembered that Musk posted a tweet saying, "Should I sell Tesla stock to pay taxes?" Soon after that, he posted another tweet that says, "Should I sell Tesla stock to buy Twitter stock?" which actually made the stock go down. This is a big issue for Nathan, since he thinks that it is all a big fugazi and that Musk used it as a big ruse, as an excuse to sell a lot of Tesla stock, which he has done when he started selling last fall. "I think he used Twitter as a big excuse to sell Tesla stock," says Nathan. What are your thoughts on Dan Nathan's warning? Let us know what you think in the comments section below. Andrew Peretta, a senior analyst who specializes in socially responsible investing at Sage Advisory Services, an investment firm in Austin, Texas, said, "From a corporate good governance perspective, Tesla has a lot of red flags." He continued to say, "There are almost no checks and balances. Even longtime Tesla optimists are having doubts, like Daniel Ives, an analyst at Wedbush Securities. Wedbush recently lowered its target price for Tesla from $1,400 to $1,000. Ives cited Tesla's problems in China, where lockdowns have throttled the supply of crucial parts and materials and demand for cars. There's a new reality for Tesla in China, and the market is reassessing the risks, Ives said. Michael Dunn, chief executive of ZozoGo, which advises companies on the electric car market, said that supply chain headaches in China are compounding by flagging consumer demand. He described Chinese consumers as edgy and worried about the future. It's a double whammy what Tesla confronts in China, Dunn said. Jesse Toprak, an auto industry veteran who is chief analyst at Autonomy, which offers electric cars by subscription, said that Tesla's market share will fall below 40% by the end of 2023, though its sales will continue to grow as the overall market expands. They will have a similar share of a larger pot, Toprak shared, but their near monopoly on EV sales in the US will slowly diminish. In fact, Tesla already faces tough competition in Europe, where electric vehicles account for 13% of new car sales. That foreshadows what could happen in the United States, where sales of battery-powered cars are just beginning to take off. Volkswagen, which has invested heavily in electric vehicles, sold 56,000 battery-powered cars in Western Europe during the first 3 months of the year, just behind Tesla, which sold 58,000, according to figures compiled by Schmidt Automotive Research in Berlin. As Tesla stock continues to fall, some important investors appear to panic. According to some, there are several big risks in investing in Tesla stock. One is that Tesla cars are still too expensive. Not only are these cars expensive for consumers to purchase, but also costly for Tesla to make as well, as pricing is still out of reach for most drivers. Second, Tesla could most possibly run out of batteries, since Tesla executives faced the dilemma of the lack of batteries to power their products early on. Tesla's world-renowned Gigafactory, which is still under construction, is supposed to solve the company's battery crisis. The lithium-ion manufacturing plant, with a planned footprint of more than 1.9 million square feet, aims to help ramp production to more than 500,000 Tesla cars annually. However, major projects, such as the Gigafactory, are often plagued with logistical or regulatory hurdles, and it remains to be seen if the factory can be completed on time. Musk has even hinted that the company may need several facilities like the yet-to-be-completed Gigafactory to meet demand. Another risk is the low gas prices. Since gasoline-powered cars compete with Tesla's products, declining gas prices make gasoline-powered cars more economically attractive. Gas prices do not have to remain at decade lows to damage Tesla stock prices. It just has to be cheap enough to keep legacy cars on the road. Consumers are less likely to transition to electric cars if petroleum-based fuels remain a far cheaper alternative. Increased electric vehicle competition is also a factor that affects Tesla stock. While Tesla is said to be the leading company in the electric vehicles market, other companies plan to enter the electric car market in the next few years, including Mercedes-Benz, Volkswagen, Subaru, Ford, and BMW. If this happens, then Tesla's market share may start to get crowded. Some tech companies may also possibly join the fray. Apple Inc., for one, believes it can challenge Tesla in the transportation industry, and Google has also placed bets on the auto industry. Some are even concerned that Tesla may never recoup enormous expenditures, since Musk once mentioned that they will be spending staggering amounts of money on CapEx. Numerous investors prefer seeing high capital expenditures, but there has to be a payoff on the other end. In an SEC filing for the first quarter of 2021, Tesla estimated that capital expenditures would likely ramp up to $4.5 or even $6 billion per year. Elon Musk, as Tesla's CEO, also became a point of concern for investors, since he is too controversial. In the same SEC filing, a note states, he does not devote his full time and attention to Tesla, referring to Elon Musk. Musk's impulsive behavior also has real-world consequences. Musk repeatedly aired misinformation about the pandemic and criticized lockdown restrictions as fascist in an earnings call with Tesla investors. His recent announcement of plans of buying Twitter also concerned Tesla investors, as they fear that Musk will indeed eventually lose interest in Tesla, as was mentioned earlier. Watch our other videos for more Tesla stock content.